Good evening, everybody. Thanks for logging in today. Firstly, wishing everybody a very happy Diwali and welcome all again to yet another monthly ritual of Netra. For the benefit of those who logged in for the first time, this document is released 5th of every month and can be downloaded from our website dspim.com under the download section. In today's session, Sahil will cover the borrowing done by the US and how does it spend its money. We'll also discuss the four big cyclical sectors and indicators. Are US bonds a big buy at this juncture? We'll also discuss some of the valuations currently in the Indian market, covering the BFSI sector majorly. We'll also put some light on the gold miners as well as gold. Why does it make sense to add on to the portfolio? So over to you, Sahil.
Thank you, Ankush, and welcome to all of you and happy Diwali in advance to all the viewers. So today we will discuss the November edition of Netra, and without wasting any time, we'll directly jump into what are the insights that we have gathered in the November issue. And so at the end, we'll also do a Q&A. You can see a Q&A tab on the bottom. You can ask questions right away. We'll curate them and answer them at the end. So this time we're going to touch three topics, as Ankush said: cyclicality, valuations, and gold. So let's look at the first data, and this is largely, I think, one of the hottest topic right now. People are talking about, how and why US is borrowing so much money. So I thought, why not look at what are the real numbers? So just to put things into context, so that we remember the overall numbers, US economy is about $27 trillion today, 27 trillion dollars, and every year it borrows a lot of money depending on what kind of deficit it is running. So roughly it spends about $9 trillion. Right now it's running about 5.5% of fiscal deficit versus on a $2.7 trillion economy, right? So roughly if you just take 30, roughly it is borrowing 1.5, 2 trillion, depending on how you look at it, in which complexion. So what I did is I put quarterly data in terms of what it is borrowing. So on the left-hand side, if you see this graph, this is the borrowing by US Treasury for trailing 4 quarters, right? This is, it is budgeted to touch about 2.9 trillion on a 12-month basis in March 24. So by the time we reach March 24, this number will be $2.9 trillion. And this is an already known fact. They have already released their borrowing calendar. So this is not an expectation. This is what the US Treasury itself is saying, right? And you can see that before the global financial crisis in 2008, US used to borrow money, but not too much, right? Fiscal deficit used to be less than 3%. They were not borrowing heavy sums of money at that point in time. And then huge spike after the global financial crisis. And then they have kept borrowing ever since. The borrowing declined over time as the economy recovered. But you can see post-COVID, there has been a huge surge in borrowing. And if you see one particular quarter in COVID, they borrowed nearly $3 trillion. $2.9 trillion is what they borrowed during the COVID quarter, right? Where they gave the biggest economic stimulus that US has ever given. And you can see that even when the economy has now recovered, they are still borrowing record amounts, right? They are borrowing a lot of money, and these borrowings are now touching about 750, 800 billion every quarter. This is the number which is going on. So just to put one number in perspective, so March 24, I've written here, they will borrow 2.9 trillion. Indian GDP is around $3.5 trillion today. So this is the size of borrowing. They are borrowing close to Indian GDP over a 12 to 15 months period, right? Very large numbers. This kind of borrowing has not happened outside of a recession ever. This is the first time that they're doing it. And what are the areas where they are spending this money? That is also very, very important to understand. Because when we look at very high government borrowing, what is it used for? Usually it is a fiscal stimulus. Governments borrow money and then they spend that money, which stimulates the economy to a very large extent, right? But on the right-hand side, what I put is, where is the US spending this money? And 3/4, more than 75% of all the money that the US spends not only the borrowed money, but all the money. All the money it earns from taxes and the borrowings. 3/4 or more is spent on non-developmental expenditure. You can see Medicare, Social Security, National Defense, Health, net interest, all these components, income security, general government, which is the running of the government itself, veteran benefits, all these components they can't compromise on that. So in a particular year, they can't say that I'm not going to spend this money. So this is like, to some extent, when you look at government of India, salaries and pensions, schemes like Manrega, etc., they can't, track back and not spend money there. Similarly, in US, there are certain areas where this money is spent. One area of interest which has been in highlight in news articles and a lot of people have written about is the net interest payments. So US runs a certain amount of debt. So US debt is about $33 trillion, which is the sovereign debt, the debt on the US government. So that debt, when they service that debt, they pay interest payments, right? So they have borrowed money, they have to pay interest. That interest payment is this number, net interest payment. This number is now reaching 10% of its total expenditure, which is a very high number. I remember in 2015, this number used to be 6%. So it has gone up significantly. And why it has gone up? If you remember the last Netra, we showed that net interest is now 3.5% of GDP, very high, largely a function of increase in interest rates. So the Fed has raised rates, and that has now started to hurt the US government because its interest payment has started to go up. And please remember that the maturity profile of US debt has not even changed significantly yet because it's too early. Interest rates have gone up only in the last 1 year, 1.5 years. And there is still a very large bulk of debt which is present historically and it has not rolled over. So, US government is borrowing a lot of money, but a large chunk of that borrowing is going to places which are actually not very stimulating in nature, and a large component is now going for debt servicing. These numbers are not very positive. So if you talk about holistically, interest rates are very high. B, they are borrowing money, but they are unable to spend it to give any significant boost to the economy, right? So in spite of running a very high fiscal deficit, the ability of that fiscal deficit to help the economy is very small. It's not very high. And that I think is a problem area, so the conclusion from this data is that US will not be able to continue borrowing these large sums. And they have only two options. One is to start borrowing less, spending less money. They can compromise in certain areas. And when they compromise, growth will get hit. Whatever incremental benefit the growth is getting from this expenditure will be shaved off. Second way out, reduce interest rates, for which the Federal Reserve has clearly stated that they want lower inflation. So if you take the second solution to be the primary driver, how will the US Fed get lower inflation? By slowing down growth. And therefore, US central bank and the government more or less wants the economy to slow down. I think that is the repair mechanism of their financial system. And this is akin to, the central bank saying that they would want the economy to slow down, asset prices to come off. And it is akin to, clearly telling you that you should be more cautious in approach right now. It can't be more direct. So this is the conclusion from this slide that this most likely will not continue. B, one way out is to slow down the economy. And we think that slowdown is possible. Let's look at the four indicators, big four indicator, what they are saying. So I've put four important cyclical indicators for US economy. One is private residential fixed investment. So what kind of fixed investment, like home construction primarily, are private residential people doing in US? You can see it has started to deteriorate. This deterioration generally we see closer to recessions, and we started seeing some deterioration fixed asset creation, which is a very large part of GDP in US. Similarly, if you see business fixed investments, it is at a healthy level, but it has started to show a downtick. In the most recent data that we had, this number started to fall. And usually business investments decline when economic environment is weakening, right? So it is yet to decline meaningfully, and therefore it sends a mixed signal. But we have seen the first downtick in the last quarter, and we'll have to monitor what happens to this data going ahead. Third is total business inventory to sales ratio. This, I think, is a very, very important ratio. And you can see that it has gone up. What is inventory to sales? What kind of inventories are businesses holding versus the sales they are doing, right? So right now they are holding about 43 days of inventory for sales. If they have to make, let's say, sale of $1, they are holding, or let's say the sale for 1 day, they are holding inventory for 43 days. This is the current number. Historically, this number used to be much higher during COVID crash. Although the number then it came down because factories were shut, inventory went off through the roof, and then now it has slowly built up. And you can see it has gone back to pre-COVID levels. So it doesn't really signify anything significant, right? If you look at this data, you will say that there is nothing important about it or nothing significant about it. We saw a spike during COVID, then it crashed, and now it has come back to pre-COVID levels. So it sends no signal, it has no implication, but that's half the picture. Okay, let me show you the live data. I've put the same chart online, and I put the GDP growth numbers here, and I wanted to show this chart and explain why it is important. So this is total business inventory to sales, the exact line which I showed you. The data is also sourced from this chart itself. And this is the real GDP growth rate, the red line on the right hand side. So there are two very clear changes which occurred. So you can see from 1990 onwards, inventory to sales ratio was falling. You can see that over time, during recessions, it went up. Then it kept on falling. What is the reason? Introduction of just-in-time techniques. And it started to fall in 1980s. The Japanese technique of just-in-time was adopted globally, even in US, and it led to dramatic decline in inventories globally, right? Second and more important point, this trend continued even after global financial crisis. So during global financial crisis, demand evaporated, recession came, inventories went up because there was no demand, and then once the recession was over, we were back to normal, overall normalcy. Then something dramatic happened in 2014. And there are two reasons. One was a very large strike which happens in Los Angeles at that point in time. And second is that economic conditions began to weaken, right? And you can see, if you see very closely, if you are able to look at this particular data, which I wanted to highlight, between 2014, if you see this bump, inventory to sales ratio is going up, economic growth is coming down. But if you watch very carefully, there is an economic bump. GDP went up for a few quarters and it started to decline, right? This bump up is a significant change of how countries grow, right? Usually when the markets or the economies are growing for a certain number of quarters and the growth begins to slow down, a lot of businesses pump a lot more production because they want to show top line growth. And this is what happens in that phase. The GDP shows a very dramatic uptick, but it doesn't last. And similarly, this is what we are witnessing today also, right? Same phenomena. GDP growth has accelerated somewhat from about, we were seeing about 0.6% GDP growth. Now we are seeing 1.4% GDP growth in US. So there has been a rebound and inventory to sales ratio has declined. This is a clear case. We've seen this repeatedly happen many times. Inventories being pushed and GDP being pushed higher, and then eventually it comes down. And this is most likely scenario which could play out. And second and more important point, the introduction of tariffs by Donald Trump in 2017-18. And when the tariffs came into force, inventory to sales ratio again started to go up. A lot more people wanted to hold a lot more inventory because of the changing dynamics, right? The question is, who is going to bear the cost of this higher inventory, right? That answer is unclear. It is an economic cost, and we will be able to see the consequences when the growth slows down. And again, very clear indication that slowdown possibly could be coming ahead of us. Another indicator is light vehicle sales, and this number is still very, very good. No major change. But think about it, interest rates on buying a new vehicle is at 7.5%, 8% in US. These numbers went up when the interest rate was 4.5%. So the incremental demand numbers have already started falling. If you read the fortnightly or monthly numbers, they are already coming down. So this again tells you that all four big economic indicators in US, they are highlighting that possibly economic growth will slow down. Next is credit offtake. So I have put a chart here for what is called non-revolving credit, and I've also defined what is non-revolving credit. It's a type of loan which has a set repayment, like an auto loan or a consumer durable loan or a white good loan, anything you can think about. It is unlike a credit card, right? It's a loan with a maturity. That is what is called non-revolving credit. And these are very sensitive to economic growth. You can see that personal consumption, which is a very large part of US economic growth, and total non-revolving credit, they usually move in the same direction, right? And what we have started witnessing is non-revolving credit is now contracting on a year-on-year basis. It's falling. So it is akin to saying, if you look at Indian numbers, Indian banking numbers, you would have seen that personal loan growth in India is 20%, 23%. In US, that number has fallen from 10% to about -1, -2%. So it has come down dramatically. Usually, we've seen that consumption follows this number with a lag. So most likely in the next few quarters, you will see an impact on growth, particularly because credit is giving you very, very similar signals. And particularly that will happen in durable goods, where credit is of primary importance. Again, an indicator which tells you the same thing, right? This, gets us to S&P 500 valuation. So first three slides told you that growth possibly in US is slowing down. And there are enough indicators to tell you the same thing. And when you think about it in a plain, simple manner, with where interest rates are, with mortgage rates at 8%, housing loan rates at 8% in US, auto loans at 7.5%, 8%, credit card loan rate at 21, 22%. I don't think it takes rocket science to know that these things will have an impact on the economy. The question is when. That answer is unknown. My understanding is maybe in the next 1 quarter, 2 quarter, 3 quarter, but there is no rocket science or any special powers required to think about what will be the impact of these numbers, because they have already started to show up in economic data. Now let's look at the second segment, which is the valuations. And if you look at S&P 500 valuations, I put down sort of a menu card, scorecard of number of valuation parameters that people watch, like forward price to earnings ratio, Shiller's P, dividend yield, price to book, cash flow, earning yield minus bond yield. On every single parameter, US economy is above its 25-year average, right? There is no parameter where it is trading below, which tells you that it is more appropriate to be cautious. Where the last reading is 17.8 for forward earnings. If you take trailing earnings, the number is around 20, 19.5 or so, which means that the market is expecting 10, 12, 15% earnings growth in US, which I think is very, very hard to go by if you look at the next 12 months. So that I think is a hypothesis, is possibly could be a spanner for extended rally. Even if US markets rally to a new lifetime high, it will find it very hard to sustain these gains. And therefore, I think it makes more sense to be more conservative, specifically about US stocks. And also similar trends are playing out in Eurozone. Similar trends are playing out in China also. Next is a cross asset comparison, and I've named it from TINA to RINA. So if you remember, TINA was a factor. It was called there is no alternative. What does this mean? That when interest rates were close to zero, we had zero interest rate policy, right? Globally, interest rates in Japan, Eurozone, UK, US, everywhere they were zero. Even in China, they were 2.5%, 3%. So there was a concept created that apart from stocks, there is no alternative for investments, because bonds are not giving you any returns. Gold had not rallied for 8 to 10 years. So people were scampering for more returns, right? So they were investing in all sorts of different instruments, even cryptocurrencies, right? So there was this concept called TINA. There is no alternative to stocks. So now what we are seeing is what I have named RINA, which is reasonable interest rates now available. So the interest rates which are now available are giving you yields which are higher than earning yield of stocks. So what is earning yield of stock? So if you divide the P ratio or do a reciprocal, that means 1 divided by P ratio, it will give you the earnings yield, which means that uh, for every 100 rupees that you pay, what is the earning yield that the stocks are giving? So for example, 1 divided by 20, which is the trailing earning yield, is about 5%, right? So that is what the stocks are earning. The US treasury bonds are giving you more than that. So the yield has turned negative. This difference has turned negative. And this tells you that stocks, on a comparative basis, because they are more volatile in nature, are less attractive versus the bonds, right? And a lot of people would have read that because of this ratio, money will move from stocks to bond, but it doesn't happen that way, right? There are different portfolios. There are very few 60-40 portfolios which move money like this. But roughly what we've seen is that incremental purchases of stocks usually slow down when bonds are giving you such attractive returns. And that I think is something which is again going to be a problem for bonds, problem for stocks. And last time we saw these kind of numbers was closer to the dot-com peak, right? Which means that stocks had become so expensive that bond yields or bonds became much more attractive. And this, I think, can play out once again, and which is again negative for US stocks and for other markets also. What is the opportunity in this? So this is the US long bond. This is US Treasury bonds. It's an index which has all type of US bonds, not only the long-term bond. And you can see that last 3 consecutive years, US bonds have delivered negative returns. So much so that 20-year return on US Treasury has become negative. Okay. So think about it for a minute. The safest asset class in the world, US Treasury, 20-year returns are wiped out. They are zero. And 3 consecutive years of negative return. And where we stand today? Interest rates which are at 20-year high, 3 years consecutive of losses. So it's a clear recipe of a contrarian trade. Okay, which means that if you go and buy the US long-term treasury bonds, it could turn out to be a very good trade, right? It could turn out to be a good investment because A, it is yielding very high returns. Second, if interest rates actually fall, which is the premise of my first 3 slides, that if economic growth is going to slow down and if US is going to borrow less or economy slows down, eventually you will see that interest rates will fall. And that is the reason why we believe buying US long-term treasury is a very good idea. And hopefully we'll be able to give out a very good product, which is very different from what is available in the market today, and which will be one of the most apt description of how to capture this trend over the next 3 to 6 months and even longer. So the conclusion is US Treasury long-term bond is a good buy. Most likely we'll be able to see some more trend play out in that direction. Next is a few important inputs on Indian economy. And similarly, as I said, global growth is slowing down. Those of you who've been attending our calls for the last 1 year, April 22, we said that there is a possibility that Indian growth could diverge from global growth. That means even if the global growth slows down, India will continue to do well. And there were many reasons to believe that that could happen. And we actually saw that happening. Our growth accelerated. Now we are seeing that we don't have that extra cushion anymore, which means that if global growth slows down, it will hit India also. What is the reason? Our top line numbers have started to slow down, right? And if you normalize or seasonally adjust GST numbers, you will see that they have started to plateau. That means the growth or the pace of growth has started to plateau. It is not going up anymore. And one very important piece of data point which I want to tell you is if you take December 2019 and take June 2023, which is the latest GDP data available, real GDP growth in India because of COVID is only 12%. Okay, so I don't know how many of you know it, but this is only 12%, a 3.3% CAGR, right? Nominal growth is very high at 9.6%. GST collection is even higher. And the reason is and Nifty levels are even much more higher. So prior to COVID, Nifty was 12,000, then it touched 20,000 now, right? So the CAGR numbers are much higher, 20, whatever, 25% or so, right? So what is the reason between real growth at 12, real growth at 3.5% CAGR, nominal at 10% CAGR, Nifty returns at 20% plus CAGR? What is the reason for this? One very important reason is that corporates where top line growth went up post COVID because of the stimulus, they controlled their cost significantly, expanded their profit margins, and showed excellent profitability, right? Going ahead from where we stand today, top line growth is going to be very difficult to come by. Okay, think about it. There are three drivers of sales growth in India. One is domestic growth, which is very clearly visible that it is plateauing. Second is exports growth. So for IT, the numbers are already there to see. You can track the numbers sequentially. Most IT majors are showing negative growth or plateauing of numbers. And another export earnings comes from metals and other companies, right? All of them are witnessing declining end product prices. So eventually the top line growth is slowing down and this will come and hurt our profitability. Currently, the market expectation is that profit growth will be 15 to 18%. I think it's a very aggressive number. If we are able to do 10 to 12%, we should be happy about it. And I think that is the base case that is possible. And because of that, I think paying 22 times or 23 times doesn't make sense. So as I said, sales growth is slowing down. You can see these numbers. S&P 500 is the blue line here. Nifty is the black line. In both the cases, the top line growth or the sales growth has started to decline, right? And you can see that they are moving together. Although a lot of people believe that every country has their own economic cycle, top line growth globally moves in a very similar manner, right? And then eventually it is the profitability that impacts the stock market. But as of now, I think one of the drivers of profitability, which is sales growth, is declining. And this is something that we should note. Next is what would you pay? As I said that if growth is going to be 10, 12%, what is the P which is justified, right? So I took data for the last 11 years. And in last 11 years, Nifty EPS has gone up by 8%. Okay. But if you look at the total return, Nifty total return index, it has gone up by 12.5%. So profits have gone up at 8%. Market return is 12.5. So what is this 450 basis points? This is the re-rating in PE multiple. So our PE multiple, which used to be on an average 16, 17, the averages has shifted higher to 20, 20.5. And the reason is market has re-rated. And what is the reason for re-rating? People are more happier giving more money for the same amount of earnings, right? Historically, what we've seen is that when this number is high, forward returns fall. That means if people are very willing to give higher multiple, they may not be very willing in the future. And that causes the multiple to decline. So let's assume that 10 years from now, the EPS continues to grow at 8% CAGR. Let's assume. And if this 450 bips expansion vanishes, that means it declines by 450 basis points, that will compromise our returns. That means rather than having a return of 8%, we'll end up with returns of only 3.5%. That is what is meant by re-rating and de-rating of P multiple, right? So we believe that the de-rating is in process right now. This number was even higher. So if you go back to September 21, these numbers will be like 6% CAGR, and this will be like 16% CAGR. So 10% differential. So I'm just saying anecdotally it could be lower, but the point is that this de-rating has started and it will most likely end closer to averages. That means a large part of this 450 basis points of re-rating will vanish. It can vanish for many reasons: slower growth, higher interest rates, or any uncertainty that we can't predict today, or we can't forecast. It can happen in the future. There is also a distinct possibility that it continues. Okay, that means the 450 basis points premium continues or even goes up. But I will not, bet on that. Usually, it is, saying that something which is already extended will extend even further, right? So betting that on that may not be very intuitive. It could be counterintuitive. The next is small and mid caps, and this looks like a complicated chart, but let me explain what it means. On this axis, we have small cap 7-year CAGR returns, forward returns. So if you start from, let's say, January 2014, if you just start from that point, sitting on that day, what is the 7-year forward return? This is which is plotted here. So for every single date, so we've taken data for each of these dates, and this is small cap 3-year trailing CAGR returns. Okay, so what is the CAGR return 3-year trailing? So if the 3-year trailing return is very high, forward returns will fall, right? This is what the chart means, that if you have made a lot of money in the last few years, then the forward return will be lower. So you can see that so right now we are here, somewhere here, 35%, 34% CAGR. So if you see this is historical data. This is not an opinion. The next 7-year returns falls below 5%. This is what the history says, right? And mid cap, the picture is much more mixed, right? The picture is mixed in mid caps. We are somewhere here right now. Even the past returns have been higher. The best fit line is lower. But in small cap, it is very clear that if you are sitting on very strong recent returns, forward returns suffer. What is the way out? Let the market correct. Let it normalize in terms of valuation, normalize in terms of returns, and it makes a lot more sense. So if you see the small cap CAGR when it is very small, that means let's say in the last 3 years, we have made only 5%, or if this bracket is there, the 7-year forward returns significantly goes up. You can see it is reaching between 10 to 15%, right? And sometimes even higher, right? So these are the clusters, and this is just the historical data. It will never look like a best fit, but you can see that it has a clear downward sloping line. Even the mid caps have a downward sloping line. That means higher the 3-year CAGR, lower the 7-year forward return. Both lines are downward sloping, but in small caps more so because of the dispersion of market cap, right? So what is the conclusion? That markets more or less globally are seeing effects from growth slowdown, which will become more apparent in the next few quarters, and we should be very open to it. Second, there is a possibility that markets will either consolidate for a longer period or will correct. I think the second possibility is much more higher, where markets could correct maybe 15-20% globally, similar amount from the top in India also. What are the global market snapshot look like? This is where we are. India is one of the most expensive market globally, and we also don't have the highest ROE that we used to enjoy earlier, right? So there is, for example, look at Brazil, one of the cheapest in terms of price to earnings multiple, one of the highest in terms of return on equity, right? So this is like the best of the lot, cheaper of the lot. This is the most expensive of the lot, but also they have delivered earnings growth. Recently, Argentina is a case in point because of the currency disturbance, so you can ignore it. But other countries have delivered earnings growth, and therefore they are here, but they have become expensive, right? And that is something that we need to be cognizant of while thinking about cross-country comparisons. Last two slides on sectoral opportunities. So in India, I think there are still pockets where there are opportunities. One, of course, is healthcare, which we've highlighted a number of times. The other is BFSI. We think that there is a clear case where if you focus on the right-hand side, the right chart, the Nifty Financial Services Index on a 4-year rolling basis is underperforming Nifty as much as it did during the global financial crisis. So, of course, there is a stark underperformance which has happened. Second, and because of that, valuations are average. Earnings growth is one of the strongest for this sector, and credit quality, asset quality is very, very high. So there is a clear case for BFSI to be one of the important go-to sector. If the market's correct, I think this is the sector where a large part of your allocation should go. Even if you are looking to start a new SIP, I think this is a sector where you should be focusing on. Very large players in this sector are available at attractive valuations, and uh, right now nobody seems to care and nobody seems to buy them. So I think this is something which is very attractive. Next is gold, particularly gold mining equities. 2 points, gold has not broken out of this range. You can see on the bottom right chart, it has struggled to break beyond this 2070, 2080 levels. I think if a breakout occurs, we'll get a new bull market. I've highlighted this in previous instances also. Second is the ratio of gold to copper. You can see the ratio has started to rise. Usually it rises when there is economic trouble. We've seen that in the past. 2008 crisis, then the European debt crisis, the taper tantrum, right? And then the Chinese slowdown, COVID. All these are reminiscence of gold outperforming base metals, largely a safe haven versus demand play. And whenever that happens, gold mining equities also outperform mining equities. Hasn't happened until now, and they remain a very cheap stock, a very cheap sector. So, what is the takeaway? If gold breaks to a new lifetime high, you can expect that gold mining equities will also outperform and they will do very well. It has not done so. Um, Although gold has broken out to lifetime high in almost all major currencies, including rupee, Chinese renminbi, and others. But in gold, it is yet to make a new lifetime high. If it breaks a new lifetime high, possibly a new bull market can emerge, and I think new possibilities will emerge for this sector. So this was the last slide, and one very important caveat. A lot of people keep on looking at the past data, last 25, 30-year returns. They've been very good in India, even in US. But what you've seen is that history doesn't repeat all the time. I was looking at dollar returns for the top major markets in the last 25 years. And you'll be surprised to know that there are only 3 markets out of top 25 where the returns are more than GSEC returns. So it's not, returns are not cast in stone, and the history may or may not repeat in terms of the same returns that we've seen in the past. So we have to be very careful when we devise our investment philosophy. So just to summarize and quickly take you through, and then we'll take questions. We are saying US most likely is going to see an economic slowdown, largely because this is the policy construct, and there are enough indicators showcasing that. Credit, again, a very important indicator, is showing the same trend. Second, valuations scorecard. If you see, there is a clear overvaluations on most parameters, so it is time to be cautious and look at valuations correcting. Bonds have become more attractive than stocks, and there is an opportunity in owning them. Indian growth is also plateauing, stabilizing, normalizing, which can hit our top line, already showing up in numbers, and our profitability. And therefore, Indian markets can derate in terms of the PE that we are doing, and which means that we could see a period of consolidation or a deeper correction. So, 2 sectors that we discussed was BFSI and gold mining companies.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.